Well, hello, and thank you everyone who've been able to join us live, and thanks to you who are watching this recording. We'll be taking this time to share with you our recent acquisition, Marketplace Square Apartments, which is a 152-unit apartment complex in Atlanta, Georgia. So before we kick off into our presentation, I'd like to just kind of go over a real quick disclaimer at a high level. You can pause here and read through the disclaimer if you'd like, but short of it real quick is what we'll be presenting tonight is just a projection, no guarantees of the returns based on multiple factors that could be beyond our control, but all details will be shared in the confidential private placement memorandum, which we will send to you if you decide to move forward with us. So let's get started. So real quick, we'll be going over the agenda and we'll be introducing the team. We'll give you an executive summary of our project. We'll roll into the market overview of Atlanta and the submarket that the property is in. We'll give you some more specifics around the property and the characteristics. We'll share with you our business plan and what we plan to do with this asset once we acquire it. We'll be sharing with you a recent case study to sample our track record. And then we'll go over next steps and call to action to participate in this project. And we'll be sharing our contact information. So I'd like to hand this over to Ben to share with everyone the sponsorship team and the operations team. So Ben, over to you.
All right, thanks, Tom. I appreciate it. So for folks that don't know me, I am Ben Suttles, the managing member of Disrupt Equity. We're based in Houston, Texas, with assets both in Texas as well as in the Atlanta MSA. I would consider myself an entrepreneur, owned several companies over the last 15 years, from IT to commercial real estate. Been in commercial real estate for about the last 5 years. Have syndicated 8 multifamily projects totaling close to 1,200 doors. With assets under management of about $75 million. We recently sold our first syndication deal, and it netted our investors over 365% return in 2.5 years. And I've also been able to raise about $25 million in my career for various real estate projects. My other managing member for Disrupt would be a gentleman named Faris Musa. Faris also comes from the IT world. He used to work at Microsoft, has also owned several software companies. And we partnered up a couple years ago to start Disrupt Equity, which is the commercial real estate firm that we own. Some of you might know Mark Kinney. Mark's been doing commercial real estate for over 20 years, owns over 4,000 units, with about 1,000 of those in the Atlanta MSA. And we're partnering up on this deal with Mark. And then on the equity raise team.
So yeah, I'll take this one over. So thank you, everyone. This is Tom Reed. And myself and Philippe will be part of the equity raise team. And a little bit about me, currently involved in about $7.1 million of multifamily units, predominantly in the Memphis MSA, and currently working also as a senior manager in the enterprise technology space. And I'll hand it over to Philippe to introduce himself.
Thank you, Tom. So this is Philippe Schelegan. So I've been working in multifamily for about 3 years now. Presently, general partner in 350 units. It's about a $12 million portfolio. Met Tom and Mark Kinney working on these deals, and also finally met with Ben and Faris, and very excited to work on this deal with them. Tom?
Thank you, Philippe. All right, so I'll hand this back over to Ben to take us through the executive summary and share some more specifics about the property, its location, and why Ben is so excited about this project. So Ben, over to you, bud.
All right, thanks, Tom. So yeah, Marketplace Square, average annualized returns on this project, we're going to be projecting over 17%. So that is going to be between cash flow and the net proceeds. So that's pretty strong. On a 6-year hold, the total return will be over 109%. And then CapEx improvements is going to be about $960K, which is we're going to add value to the property by improving it and continuing what the current ownership is doing. And we'll get into the details of our value add plan later on in the presentation. One of the big reasons why we like this deal is the prime location. So it's adjacent to a place called Camp Creek Marketplace, and that's a 1.2 million square foot premier retail destination serving the area. It's got the only Target in a 10-mile radius in the South Atlanta submarket, spans about 30 acres, and it sustains an employment base. This is direct employment of about 2,000 people, and it serves a trade area of about 460,000. So it's a big economic driver in the area, and that continues to spurn more and more development because that is already in place. So some of the employers at the Camp Creek Marketplace are going to be Lowe's, Target, BJ's Wholesale, American Signature, LA Fitness, Marshalls, Ross, TJ Maxx, AMC Theaters is there, Staples, PetSmart, Starbucks, and it's one of the only Starbucks in this sub-market. And one of the reasons why we know of this deal is that this is the Starbucks that we usually hit up when we're in Atlanta visiting our other properties. So the current ownership has already done a lot of the heavy lifting. So they put $2.7 million into the property already, and that included 88 units that have been completely renovated, granite countertops, new trim, cabinets. So there's a lot of opportunity to continue to upgrade units, so we can continue to do the rest of those units, as well as just opportunity to increase revenue through bringing on more amenities. Think playground, think updating the parking lot, think better signage. All of those things are what we're going to be doing as part of our CapEx improvements. Additionally, there'll be $2 million in upgrades from the FAA. So the property is about 3 miles away from Atlanta Hartsfield, which is the biggest airport in the world. And one of the things that you can do if you are close to an airport is you can apply for what's called the FAA Noise Mitigation Program. It's a grant program, so you do not have to pay this money back. And if approved, and it's quite a bit of a process, the property has to be in certain conditions, certain occupancy, all of those things have to be checked off before you can get approved. Well, the current ownership did. And so they're currently going through the process of not only updating the doors, the sliding doors, and all the windows to not only noise-proof, but also weatherproof. So as you can see, there's a lot of updating that's already going on or has happened, and then we'll put close to $1 million into it. So that plus the prime location that it's located in are some of the reasons why we're really, really excited about this project. So, why Atlanta and Marketplace Square Apartments? Obviously the Atlanta market is just, the organic rent growth is 3.3% over the next year, which is incredible. And that's without pushing rents, that's without us, obviously updating the property. That's what the Atlanta MSA is already getting. The greater Atlanta's population is forecast to grow 9.6% over the next 5 years as well, surpassing 6.4 million residents. So not only do you got rent growth, you've also got population growth, which is a big thing that we like to see. So average rent trails their competition by $169. This allows a lot of room to not only continue to upgrade the units, but also just push rents across the board, even on the classic units. So the team, like I mentioned in the previous slide, will put about $1 million in rehab. And once you couple that with the FAA grant and the $2.7 million that the current ownership has done, you're close to $5.7 million in upgrades on a $9 million purchase in the last 2.5 years. So it's putting us in a very good equity position moving forward when we go to get permanent financing. So in terms of a market overview, the Atlanta MSA, like I said, is growing. It's grown 79% since 1990, making it the nation's 9th largest MSA and one of the fastest growing. Atlanta is expected to add 43,000 jobs in the next 12 months. So you've got rent growth, you've got population growth, you've got job growth. All of these factors are things that we look for when we're looking to invest in a submarket and looking to invest into a project. So it's top 5 projected job growth metros through 2020. So that's not just this year, that's through into the future. The massive 29 county region that the Atlanta MSA includes 15 Fortune 500 companies, 66 institutions of higher learning, and as mentioned earlier, the busiest airport in the world in terms of annual passengers. And Atlanta Hartsfield Airport is a very big economic driver, not only the airport itself, but also the jobs that are created in that immediate area is a huge economic driver in the submarket. So this is a slide that we like. It kind of shows all of the statistics of the Atlanta market and why we really are drawn to invest there. And I won't go through every single one of these, but one of them that I did want to point out, obviously you see the Fortune 500 companies. These are company headquarters. These are not just, they've got a high concentration of jobs there. This is where these are headquartered at. You got, brand names, Coca-Cola, Home Depot, Delta, UPS, NCR. All of these are household names, and they're all based in the Atlanta market. So we like to see that when we're investing in a submarket as well. And then obviously you've got all these other factors that are just, gravy in terms of why you want to invest in the Atlanta market. So the apartment market overview. So this is sub-market specific. This is not, now we're going from very general, the Atlanta MSA, down to a very kind of tight key 3-mile radius. So existing square footage in terms of office space, 2 million, retail, 4.9, and industrial, 12 million. So you've got quite a bit of square footage that is only going to equate to jobs that our tenants are going to be able to fill. So within the sub-market, average effective rents have increased 41% since 2010. And then you've got a limited development pipeline too. So you've got a lot of demand and you've got a constrained supply. So that's obviously helped not only increase rents, but it's tightened the vacancy to 6.3. So within a 3-mile radius of the subject of only 3,395 units have been delivered since 1986. And then you've got limited development pipeline, that's happening right now outside of the immediate Camp Creek area. So that just drives, the opportunity to increase rents and as well as continue to have that tightened vacancy, which we like to see. So this is just kind of a map that we wanted to put out there for potential investors just to kind of see where some of the things are located at. So as you can see, you got number 1, you got the airport. Number 2, Ashley Furniture Warehouse, Siva Logistics. Number 3, you have additional, drivers, Facet Technologies, Dick's Sporting Goods. Number 4, you've got Amazon. Number 5, you got a corporate park, it's including Clorox, All American Containers, National Power Sports Auctions. Number 6, you've got the Georgia International Convention Center. You've got number 7, you got Cisco, another corporate park, which obviously includes the Coca-Cola, DHL, and a lot of other freight forwarders and logistics companies in that number 8 area. And then number 9, like we had mentioned before, there's where Camp Creek Marketplace is. And as you can see, it's adjacent to the property. So we wanted to kind of show this because it shows a lot of the different, job growth areas in this immediate area. So the next slide shows you, just kind of the distribution logistics corridor that the property is located in and some of the additional economic and job growth factors that we kind of see. So you got Walmart, you got Google, you got Gillum Logistics Center, you've got Atlanta Metro Studios, Fort McPherson. You've got all of these things in the area of Marketplace Square, which we like to see. And, obviously these are all within driving distance. And the other thing that we like about the Atlanta market is it's got a very robust bus line. So your tenants are always going to be able to get to their jobs, which are located fairly close to this property. So another map that we wanted to kind of show the, where things were located at in coordination with or in conjunction with the property itself. And as you can see, these are all kind of, brand names that people kind of know, and this is all within walking distance of the property. So we just want to kind of show that map right here, which is pretty powerful. And then nearby entertainment, you've got the Camp Creek Marketplace, as we said. You've also got Greenbrier Mall. You got Adams Park and Recreation Center, and you've got College Park Golf Course is within the, the immediate vicinity of the area as well. So nearby education, as I said in an earlier slide, Atlanta has a lot of higher, learning institutions, and Marketplace Square is close to several of those. So you've got, University Perimeter College, Kennesaw, Georgia Institute of Technology, as well as the elementary schools, middle schools, and high schools, which are all within a 10-minute drive of the property itself. So the property summary, there's the address there. It was built in 1971. The units we've got 152 units, rentable square foot 152K, land size close to 10 acres, and the average unit size is over 1,000. So the one thing about the Atlanta market is that the units are very, very big, even in comparison to something like in Texas, where you think that we would have bigger units, but really Atlanta is one of the biggest in the country. So let's do some math. So current owners have invested $2.7 million. 90% new HVAC, 90% new water heaters, new siding, new railing, and balconies. They did the Juliet balconies, which you'll see in some of the later photos. 50% of the units have been heavily updated. You got $2 million will be paid by the government because property was approved for the FAA noise reduction program. That means 100% brand new soundproof and weatherproof windows, front doors, and balcony sliding doors. And as part of our CapEx plans, almost $1 million. So you've got close to $6 million in improvements that are going to be in the property already or going to be within the next year on a $9 million purchase. So, we like going into properties where we've got a good story, and between that and the location, we're really, really excited about that one. So here are some of the floor plans. We always like to kind of include that to give you guys a little bit of a perspective. So you've got 2 bedrooms, on this slide, and then you've got a little bit more of a breakdown on the different floor plans on the next slide. So we've got two bedrooms and 3 bedrooms in this property, and here's the unit mix. 88% of those are 2 bedroom, 12% are 3 bedroom, and once again, the average square footage is over 1,000 square feet, which is pretty big. So this is just a slide kind of showing what some of the updates look like. And as you can see, they did a pretty good job. So, we'll obviously continue to mirror that with the units that we'll be bringing online. And here we're just continuing to kind of show some of the interiors on this slide. So we like to always kind of show that, as well as the exteriors. As you can kind of see, they did the Juliet balconies, they did all new siding, and they really did a very, very good job. They essentially just ran out of money. So, and they're in the process of buying 5 more deals, and that's kind of the backstory as to why they're selling. So they need to free up some capital, and they left some meat on the bone for us to kind of come in and finish up the business plan on this one. So here's another slide just showing some more exteriors. As you can kind of see those balcony areas, as well as just kind of the patios. They did the wood trim on the patio, which we really, really like. And so, we'll continue with, obviously improving the interiors, but they've done pretty much all the heavy lifting on the exterior and all the deferred maintenance. So the property amenities, it's got an after-school program, which we really, really like to see. We always like to encourage a sense of community at all the properties that we buy. And the after-school program has been wildly successful. So we'll continue to do that because that is a true amenity, and that's something that the tenants will like. They'll continue to be loyal to the property if you continue that program. So we will do that. They have carports available, courtyards, leasing business office. As you can see in this picture, that is where the leasing office is. It's got a playground, which we'll improve upon. It's got a laundry facility, which we'll improve upon. But there are washer and dryer connections in select units. And then once again, leasing business office clubhouse. So the opportunity. So what are we talking about? 152 units, $9 million purchase price. So we're getting this at a very, very good cost basis at $59 a door. Earnest money is $150,000. Our first mortgage is going to be about $8,040,000. We have mortgage terms it's a 3-year term with 2 1-year extensions, so up to 5 years. We have an interest rate of around 5.85. Interest only is the full term. Plus, we're underwriting 1 year upon a refi of interest only as well. Rehab budget of $960K. Acquisition fee of about 1.7. Reserves and working capital, $165K. So the total needed to close would be about $2.5 million. So the loan type is a bridge debt. We're using Bank Corp, which is a top tier lender. They're publicly traded firm, and we've worked with them several times on other properties, and they're doing the in-house servicing, so it won't be a third party. And we've got a great relationship with those folks. They're giving us a great deal on this, and they're bullish about the property as well. But what Bank Corp does, obviously, they're looking to place us in the permanent financing realm very quickly. So they work with us as quickly as possible to be able to refi into the permanent debt, which would probably go with either a Fannie or a Freddie small balance loan. So that would be what the loan type would be. And then the investment projections. So we've got a 10+% average cash flow throughout the hold, 108% total return, 16.91% average annualized return. So those are some of the investment projections. So the rent comps. So this is just kind of showing what some of the competition is at in terms of their rents versus where Marketplace Square is. So as you can see, there's quite a bit of growth there just to push rents to where the market is. Regardless if you update the units or you're trying to push rents on the classic units, we've got room to maneuver on this. So this is just a table that kind of shows some of the sales comps in the area. You know, as you can see, the comp average is about 66 a door. And as mentioned, we're buying this at 59. So we're getting this at a very good cost basis compared to where things have traded at, even as far back as a year or two ago. So things have been trading fairly high in this immediate area for quite some time. And so we're excited to get this at the price point that we got it at. And then the next slide, essentially the business plan. So we've got a management company. Province Realty is the name of our professional third-party property management company who we currently use on all of our Atlanta properties. They currently manage 8,000 plus units in the Southeast with a majority in the Atlanta market. So they manage several deals in this immediate area over the years and are very familiar with not only the submarket, but this specific pocket and this specific deal. As mentioned on previous slides, $960K in improvements, property improvements, not only new signage, updating the landscaping, solar screens. You don't really see the solar screens on the Atlanta market, but we're bringing that as something that we've done and had a lot of success with in the Texas market, bringing that over that gives a nice clean look. Another thing that you don't see a lot of is the fenced-in first floor patios. So we'll be doing that, and it's a fairly cost-effective way to improve the look and feel of the property. And you can charge a premium when you've got a fenced-in patio area. Playground, it does have a playground, but we're going to be improving upon that. We've got kids that obviously live at the property. You've got the after-school program. We want to provide that sense of community and that family feel that we like to see in our properties, and so improving that playground area is going to be a big part of that. So as part of the business plan, it's all about the bottom line. So we're increasing the NOI, reducing expenses. So update and bring online these strategic units for immediate revenue boost, move rents to market, and reduce expenses. So the current ownership is kind of owner operating the property right now, and the property management staff that's on site has been pretty laxed on a lot of things. And I think that there's a lot of places where we can tighten up things and improve not only the revenue is the easy side, but I think we can streamline and improve upon some of these expenses as well to increase that NOI number. So the estimated rehab budget, here's kind of the breakout here. So as you can see, the majority of that is going to be the interior upgrades. We've got some money earmarked for the office and the clubhouse, some money for the roofs, parking lot, landscaping, update, add in amenities, signage, solar screens, fencing, foundation and plumbing. Obviously, we're going to include that, and then a buffer. So, whenever we get into a rehab play, we always like to include somewhat of a buffer, of a contingency, so we have enough money to obviously execute our business plan. And if anything pops up, we've got that reserve baked in. And then if we don't use it, we'll just continue to improve the property. So there's a lot of buffer and contingency already built into this plan already. So this is a pro forma table that we put together just to kind of show the rents, the vacancy, the income, the expenses, the CapEx reserve, which gets you to that NOI number. So I'll start from the top. I won't go through every single number here, but just to kind of give you some perspective on how the table flows. So the economic vacancy, and which includes physical vacancy, as well as things like delinquency, bad debt, write-off, loss to lease, all of those things are included in that economic vacancy number. And then we also bake in a rent growth and expense growth projection number above that. So that gets us down below to the year 1, 2, 3, 4, 5, and 6 breakouts of the gross rents. Then you deduct your vacancy, then you add in your income to get you the net income number. Then that's going to be our expenses for year 1 of $823,000. We have a CapEx reserve. So on top of, the rehab contingency, the lender will also expect us to, reserve, CapEx budget. And so that's about $38K a year. And once again, if you don't use it, it can go back to the property when you sell, or we can use it to just continue to improve the property. So that gets you to the NOI number of 574. And then that just trends outward from year 2 through 6. So this is another table we put together. This is the projected investor return. So all of these numbers are net return to our investors. You got your 8% preferred return on this deal. We're doing a 75-25 split, and this is net of debt service, and this is net of the 1.5% asset management fee that we'll take. So you've got before tax cash flow in year 1 of 103. So it's a little bit tight in year 1, but that's because we're doing our value add and we're pushing rents. The real play here is year 2, where we're going to obviously capitalize on that increase in revenue, that increase in NOI, and then we'll refi out into the permanent debt, returning about 25% of the capital. So that will be part of that year 2 event right there, which we summarize down below in the sample investment. And then we go into year 3, which is going to be part of the permanent debt, and we'll hold through year 6. So that gets us, and this is on a 7% exit cap rate. So right now, current cap rates in this area are 5.5 to 6. And so we're going to be exiting this at a 7% exit cap rate, which we feel is pretty conservative. And then you've got that 17 roughly percent average annualized return number right there. So down below, just a sample investment for a $100,000 investment. This is kind of what the breakout would be. And that gets you to the $208,720 number in year 6. So post-acquisition expectations. So what are you going to see from us? So we'll be giving monthly reporting to our investors, and this is the highlights. We usually give an executive summary along with the monthly financials. Quarterly distributions. Investors should expect distributions quarterly starting at starting at months 9 to 12. Obviously, this is a rehab play, so first year, we're probably going to hold off just to make sure we can get through our value add, but everything is going to be net of that. So all the returns that you see, there will be a catch-up period, so it'll be starting in 9 to 12 months. Communication, as we said, we communicate the good, the bad, and the ugly. We do that on a monthly basis. If we feel like it needs to be done on a weekly basis, we do that as well. And so we over communicate when it comes to our acquisitions because we feel that that's important, that our investors need to hear from us on how things are going. So just a little bit of background. So you got the new tax laws have allowed us to do some things that are pretty cool. Obviously some people have heard about cost segregation studies. And so we'll obviously be including that. Obviously with all of the value add CapEx that we're going to be doing, we're going to be able to depreciate that, within the first year, and all of this, the way that we structure these deals, that depreciation is able to be passed through to our investors. So it's a huge, huge benefit that we can't bake into our returns because everybody's tax situation is different, but rest assured it's quite significant. And so that means this deal will create a large depreciation loss, which helps in everybody's kind of personal tax situation because it allows us to write off that loss in year 1. And that's, obviously a benefit to our investors. So IRA funds are accepted, solo 401k funds are accepted, EQRP funds are accepted, as well as we'll just take a cash investment as well. And we're always happy to talk with, your IRA custodian, get any kind of paperwork that is needed. Obviously that's where a lot of our investments come from. So we know that process and can kind of help facilitate that. So we do want to obviously let people know that those are accepted on this deal.
All right, well, here we are in the case study, and I just wanted to jump in real quick, Ben, and say, you're doing a great job of giving an overview of the property. I feel like I received an undergraduate in the market of Atlanta and all of the businesses around that area. But
Yep.
yeah, I think it's great. But I think this is really what I was looking forward to in the presentation is your Huntington Park case study. I mean, this is just a fantastic story, and really looking forward to hearing you share a little bit more of the details on this, and for me to jump in and talk a little bit to give you a little bit of a breather. But I'm going to toss it right back to you, bud.
All right. Thanks, Tom. So yeah, I mean, I think we wanted to include this because obviously, Tom and Philippe, we wanted to let your investors know that we're not just out there, buying deals. We've sold deals as well, and this is a deal that we were very, very proud of. It worked out very, very well, and we wanted to kind of shine a spotlight on it to show the full cycle of what can happen in the power of multifamily. So this case study is called Huntington Park. It's a 92 unit in Beaumont, Texas. It's garden style, as you can see. It's got the flat roofs. It's got the mansards. It's that 70s look that a lot of properties were kind of built, especially here in Texas. Purchased in the spring of 2016. We implemented an initial value add program. Got that all done, and then Harvey hit. So literally, we got our CapEx budget, which was about $500K. We went through all those improvements. Got that done, and I think in the spring of 2017, and then Harvey hit in August 2017, and 33 units, as well as the office clubhouse area, this beautiful area that you see in this picture here, that was all under about a foot of water. So, needless to say, we had to go back and do another round of improvements. We also own 2 assets nearby, so I can kind of talk to those, but I wanted to highlight the Huntington one. So on to the next slide here. So you've got the acquisition, the underwriting. So this is actuals. This is what we projected to our investors on that deal versus where we sold the property at. So, this is a pretty powerful table here, folks. So we've got purchase price, $2.9 million. It was essentially a 10.1 cap on actuals, $32K a door. That's our note amount. We got 80%. We got max leverage on this deal, loan to cost, which means purchase price, rehab, and closing costs all baked in, and they take 80% of that. The equity needed on this deal was 801. Our year one projection of cash on cash was 17.7, which is pretty healthy. It was healthy even back then. Year two, cash on cash dropped a little bit to 13.8. Reason being is we had 1 year of IO on this deal. And then year two projected average annualized returns was 25.5. Year two projected IRR was 24.6. Year two projected total return was 51%. Our reversion cap rate on this deal, because it was in Beaumont, which is kind of a smaller tertiary market here in Texas, which some folks might not even know of. And it's not like an Atlanta or a Houston market. We were a little bit more even conservative on that deal, and we had an 8.5. So you fast forward, we got through the 2 rounds of rehab that we did. We ended up putting in about $2.5 million into the property. So as you can see, our purchase price was 2.9. We added 2.5. So, you've got a ton of improvements that we added to it. Our sale price this last year was $7 million, or $76K a door. So you guys can kind of do the math. We did obviously have to pay off our note. We did have a prepayment penalty on this deal because this was a Fannie Mae loan, and they always have a prepayment penalty. Another good thing about kind of going the bridge debt is that they don't have that prepayment penalty. Once again, the equity, $801,000. Year one cash on cash, this was actuals, was 17.2. I could have paid out probably 30%. I'm going to tell you why I didn't do this, and I run all of our properties like this. You always want to have a buffer. You want to have a war chest. So even if you can pay out 30%, hold some back because you want to have that in case something happens. And I'm going to tell you, whenever Harvey hit, if we didn't have that buffer, we would have been in a really tight spot. but we were able to continue to pay all of our bills. We were able to continue to pay all of the note on the property. And that was all when we had to take it down to 66% occupancy, because obviously we had to ask all of those folks to leave once their unit was flooded. And if we hadn't done that, we would have been in a really tight spot. So what does this equate to? Year 2 cash on cash returns, 76%. It includes all the operating capital after the sale, as well as the return. We came in under budget on our rehab on the second time after Harvey. We were able to return that money as well. So that equated into a 76% return. Year 2 average annualized returns was 182%. IRR was 140, which is, I know it seems incredible and crazy and just maybe plain wrong, but that was the actual number. Year 2 total return was 365%. So our net proceeds just at sale was $3.7 million. So to kind of, drill down on that, if you had invested $100K in that deal, you would have gotten your $100K return of capital. So we would have returned that money. Then on top of that, you would have had $365K return on capital in 2.5 years. So, we hope all deals can be this great, but obviously we know that this one's kind of an anomaly, but we like to kind of show the power of multifamily and what can be possible. And I think the other reason that we wanted to bring up this case study is it's somewhat similar to Marketplace because of the amount of equity that we put into this deal versus what we're putting into Marketplace Square. You've got the power of, you put that much value add CapEx into a deal, you're sitting on a pile of equity. So I think that can only be a benefit for our investors.
Yeah, thank you, Ben. I mean, this is a great case study. This is a really good one. This is when things work out, and this is the goal that we try to achieve with all of our assets and all of the projects we work on. It'd be nice if they all kind of returned these amazing numbers, but like you said, it just kind of goes to the power of syndication and getting into these multifamily projects. So, well, with that, I think we'll bring Philippe into this to kind of share with us the next steps and what we have in store if this is of interest and you'd like to move forward with us. So, Philippe, you want to take us through next steps and round it off?
Yep. Yeah, thank you, Tom. So next steps, reach out to Tom and I if you're interested. We will send you the investment packet, which is the private placement memorandum and subscription agreement, as well as the LLC operating agreement. We'll review, accept the investment. Just something to note, it's only for accredited investors and non-US residents as well. After, when we have reviewed, accepted your investment, we'll expect you to wire the funds, and we'll be good to go for closing. So as usual, it's a first come, first served basis, and the minimum investment is $75,000. But I wanted to just as a summary, Tom and I were really excited about working with Ben and Ferris. As you have heard, they are really strong operators. They're experienced in this market, and that's really important for us to work with experienced operators in a particular market. And also, they have very, very conservative underwriting, and I think the case study demonstrated pretty well, how conservative underwriting can lead to terrific results, even though you had a hurricane coming through. The area is well known, as I just mentioned. They have several hundred units under management there. A good partner with a property management company, and they purchased. We purchased this deal, with meat on the bone. So that's really terrific opportunity here, and again, really excited. 2.1 equity multiplier, pushing to 11% cash on cash. great investment. So you can contact Tom. You have his email address and phone number, or you can contact me. And we're looking forward to hear back from you. And thank you very much, Ben.
Yeah, thank you, Ben. Appreciate you taking the time to go over the property and share the details with us so that we can share it with our investors. And thank you, Philippe, for kind of summarizing what we like about this deal and why we're excited. And I'm sure folks listening to this who've made it this far can get a sense of Ben's passion and excitement as it relates to this property, but just also as it relates to multifamily syndication. We're really excited to work with Ben, Ferris, and Mark, and I think this is a great project, and looking forward to having some great success. So
thanks, guys. We appreciate it. We look forward to getting this thing to the closing. Just one little side note. Obviously, we're trying to close out by early April. So, just wanted to kind of reiterate that to your investors as well.
Yep. Thank you for that, Ben. All right. So with that, thank you everyone who've made it to the end of this presentation. Thank you for all the folks here live, and thank you for everyone who's watching this recording. And we look forward to talking to you soon. Have a good night. Thank you, everyone.